Thank you for joining us for today's webinar. For those of you who don't know me, my name is John Gaskell, Head of Personal Financial Planning here, and I'll be facilitating today's webinar and stimulating Q&A at the end of the session. So as you can see, today's session is on using trusts for tax and financial planning, which I'm delighted that we're delivering in association with MHA. And we'll also have a speaker joining us from MHA's Wealth. So a lot of material, lots of things to cover, and I think a couple of the messages that are certainly going to come out from this is the need for integrated planning, and also I think, as you'll see, the relevance of trusts during lifetime, not just as later life and estate planning tools. So I'm conscious of not taking up too much time here. Without further ado, I'm going to cross to our first speaker, which is Kat McEwen. So over to you, Kat.
Thank you, John, for that introduction. Just want to thank everyone for joining us today. And I'm just going to give a little caveat. The advice we're giving today is to do with UK trusts only. There's no offshore trusts and trusts created by UK domiciled settlers as well. There are some slides in my section that relate to Vulnerable Persons Trust, but due to the time constraints that John mentioned, I won't be covering those today. The slides are a little bit wordy, but hopefully they'll be a good reference for you to come back to in future, because you can take them away and look back at it to refresh your mind. So what is a trust? Trusts are created when a settler gives property to the trustees to hold and manage under the terms stipulated by the settler in a trust deed for specific beneficiaries. The beneficiaries can be named individuals, or they can be a class of beneficiaries, such as the children and grandchildren of the settler, for example. Moving on from that, I just wanted to briefly touch on the Trust Registration Service. This was established in 2018 for taxable trusts initially. It's been extended to all UK Express trusts unless they're specifically excluded, and there's a list of certain excluded trusts on HMRC's manuals. UK relevant persons, which include accountants and tax advisors and legal professionals, have an obligation when starting an ongoing relationship with trustees to ensure there are no material discrepancies on the TRS. So this includes if it's not registered, if the details are wrong or there's missing information. If it's just a spelling mistake, that's not a material discrepancy. And for our own purposes, we are supposed to be reviewing what's on the TRS under our AML obligations and continuing customary due diligence to make sure it's correct and up to date. If we find an error, we are needing to be reporting this to HMRC within a reasonable time if the trustees refuse to correct the error. Okay, so types of trusts. Starting off, we have the Bear Trust. Bear trusts are relatively straightforward. Essentially, the beneficiary, when they're over 18, they're absolutely entitled to the asset. They can tell the trustees what they have to do with it. If it's, as long as it's a lawful instruction, the trustees have to follow that instruction. The only difference is if the beneficiary is a minor, the trustees have a little bit of discretion over managing the assets and making sure it's dealt with correctly until the beneficiary is over 18 years old. Discretionary trust, they give the trustees flexibility if and when to make a distribution of income or capital out of the trust. The beneficiaries don't have a right to receive income, but the trustees have a duty to consider the beneficiaries and their needs when they make trust decisions. We then have interest in possession trusts. The beneficiary of this is normally known as the life tenant. During their lifetime, they're entitled to the income as it arises. After the life tenant dies, or if the life interest is terminated during the life of the life tenant, the capital of the trust will pass to the remainder beneficiaries, and these can be either individuals outright, or it can stay in a discretionary trust or another type of trust. And then we have accumulation and maintenance trusts, which you might also hear of. These were more commonly set up before 2006 as they had IHT benefits. The trusts are usually discretionary up until a certain age, usually between 18 and 25. And then at that point, the beneficiary will receive an interest in possession in the income of the trust, but the assets will still stay on that trust until they pass away, and then it will pass to the remainder beneficiaries at that stage. So moving on to how the trusts are taxed. We start with bare trusts. As I mentioned, the beneficiaries are absolutely entitled to the asset, so they're taxed on the income as it arises, and liable. They need to report it directly as if it was held by them legally and taxed on it at their marginal rates of tax. In very rare occasions, the trustees sometimes report the income and pay the tax on it, but usually it'd be for administrative purposes. Say if there was a large number of beneficiaries for receiving a small amount of income, it's just easier for the trustees to report it. In a discretionary trust, the trustees, they will be liable to tax at the rate applicable to trusts. This is 45% on savings and non-savings income and 39.35% on dividends. There's currently a £1,000 starting rate band. The income within that is taxed at the basic rates, but from April 2024, that's being replaced with a £500 exemption. The exemption means if the trust income is under £500 in total, they don't have any tax due and no tax reporting obligations. But as soon as the income's over £500, it's all taxed, and it's all taxed at the rates applicable to trusts. The tax paid by the trust forms a tax pool, and that's used to frank distributions to the beneficiaries. A taxable charge arises if the trustees distribute income with a tax credit that's more than the tax paid and in the tax pool. The beneficiaries then receive the income with a 45% tax credit. So a £55 distribution is net with a £45 tax credit. The beneficiary receives £100 gross income. They're then taxed on that as non-savings income. Where they're not additional rate taxpayers, they can get a refund of that £45 tax paid by the trustees. So interest in possession trusts, they pay tax at the basic rate on their incomes, 20% for dividends, 8.75%, 20% on savings and non-savings, 8.75% on dividends. They don't have personal allowance, the personal savings allowance or the dividend allowance. They can't claim for property or trading allowances either. The beneficiaries are entitled to the income as it arises, and they're taxed on that whether or not the trustees pay it out to them in the year it's received or not. They should be given an R185 form with details of the income and the tax credit paid by the trustees. And the beneficiaries are entitled to all of those allowances to set against the trust income. So it could be that the trust has paid tax that the beneficiaries won't actually be liable to pay, so they can still claim a refund. But if they are higher up, higher rate taxpayers, they will be liable to pay more tax on the income. If we move on to capital gains tax now. Bare trust, as with income tax, the beneficiary is liable on the tax as it arises. When it's sold, they're directly liable, not the trustees. They've got their own annual exemption, they've got their own personal capital losses that will set against it, and they'll be taxed on the gains at either 10 or 18% if it's within the basic rate band, or 20 or 28% if it's in the higher rate band. The 18 and 28% relating to gains on residential property. Discretionary trusts and interest in possession trusts, the trustees in both of these situations are liable to capital gains tax at the higher rate, so 28% on residential property and 20% on non-residential property gains. When the trustees appoint assets out of the trust, that is a chargeable event for capital gains tax purposes. So trustees need to ensure they have funds available to pay the capital gains tax in those circumstances. There is scope for holdover relief to be claimed in respect of gains arising when assets are appointed out, but conditions need to be met and the beneficiary and the trustees need to make an election for that to happen. Just a quick point with regards to residential property gains, they are reportable to HMRC and the tax due needs to be paid within 60 days of completion of the sale now. So just bear that in mind. And then we'll skipping over those ones just for now. So moving on to inheritance tax. Bare trust, the same treatment as before. The beneficiaries are absolutely entitled, so it's within their estate for inheritance tax purposes. When they pass away, it will be taxed at 40% in their estate. If they give it away, it's either a pet or a chargeable lifetime transfer. So discretionary trusts, these fall within the relevant property regime for inheritance tax. There's tax when a trust is created, on each 10-year anniversary, and when the assets are appointed out to beneficiaries. The 10-year charge is a maximum rate of 6%, but it will often be a little bit lower if you've got a nil rate band available. In a simple scenario, the tax due on a 10-year charge is usually can be calculated by deducting the nil rate band from the total value of the trust and multiplying the excess by 6%, but that doesn't always give you the correct answer if there's previously chargeable transfers, distributions from the trust in the 10 years up to the anniversary date, there's related settlements or same day additions. The rate applicable to distributions, the exit charges and proportionate charges, is based on the value of the trust when it's created or at the previous 10-year charge. And you basically tax the value that's leaving the trust at the rate calculated based on those previous events. So if the IHT rate on the previous 10-year anniversary was 6%, 5 years later you appoint assets out, the rate applicable would be 3% because you pro rata the rate from the previous event based on the length of time that's passed since that event occurred. So I just wanted to touch on pilot trusts or the RISAF principle. With regards to the 10-year charge, the exit charges for discretionary trust, the rate applicable to those events is affected by the value of related settlements. A related settlement is one set up on the same day by the same settler. But if you set up trusts Monday, Tuesday, Wednesday, Thursday, Friday, they're not related settlements because it's not the same day. So historically, people would set up 5 trusts, 5 different days, and then in their will, add the assets to the trust. And then each of those 5 trusts would still have its own nil rate band, even though they were set up very quickly and all the assets gone on the same day. So it was quite good planning. HMRC has counteracted this slightly by the same day additions rule, so it can't be used to pass assets on death, but it is still very useful if you're holding separate life assurance policies, because the proceeds can remain in the trust after the policy pays out, and it will be very useful. So we've got an example of how using 4 policies held in trust, created and settled on separate days has been beneficial for IHT. You can see that if you got the full value in one trust, you end up with paying IHT on each 10-year charge. But if they're in 4 separate trusts, they each have their own nil rate bands and there's no IHT arising. So that's saving over £27,000 in this example. So if we just move on now to interest in possession trusts, these are a little bit more complicated following rule changes in March 2006. So if you are a qualifying interest in possession trust, which would be a trust for a disabled person, an immediate post-death interest, which is a trust created by the will of a deceased settler giving someone an interest in possession immediately after the death, or a lifetime interest in possession, which was created before 22nd of March 2006, the assets of the trust are deemed to be part of the life tenant's estate. They will be liable to tax on the death of the life tenant at 40% in the estate, taking into account the life tenant's nil rate band. The trustees receive a CGT free uplift in the base cost of the assets, or the the remainder beneficiaries who will receive it usually immediately after the life tenant passes away. If the life tenant terminates the interest in the trust while they're alive, that is a PET to the extent that the assets pass to individuals, or a chargeable lifetime transfer if the assets remain on trust at the time. So if you just go back, James. So if it's a non-qualifying interest in possession trust, the assets fall into the relevant property regime, and then they will be taxed as the discretionary trusts were on the 10-year anniversaries and on the assets passing out of the settlement. So thank you. So just a few little points to consider. The reporting time limits if you have a chargeable event in a trust is 6 months from the end of the month of the chargeable event. Business property relief, if a client has business property assets, they can be settled without incurring an inheritance tax charge, no matter the value. If the trustees hold business property relief qualifying assets on the 10-year anniversary, there's no IHT due on those assets. And then after that 10-year event, the rate of tax applicable to exits could be 0% if there were no other assets. And so even if you sell the BPR qualifying assets and appoint out chargeable assets, you still wouldn't have to pay IHT by the trustees because the rate is calculated based on the previous event. But you need to bear in mind that in the first 10 years of the trust, the way you calculate the rate is slightly different and you don't take into account BPR. So that wouldn't be the case. And if you sold the BPR assets and appointed the cash out, say, within the first 10 years, then there would be a charge in that case. So some points planning for the 10-year charge in a trust. It can often be beneficial if you've set up a trust with assets within the nil rate band. If in the first 10 years, those could be appointed out with paying inheritance tax. So if there's been a significant increase in the value within the first 10 years, you can appoint them out just before the 10-year charge without paying any inheritance tax, which is often quite good. But you do need to consider, is it actually a good idea to appoint the assets out of the trust? Is it what is right for this settlement? It's also can be beneficial, even if there will be an IHT charge, it's sometimes going to be a lot less than the 10-year charge because of if there's been a significant increase in the value. It's also possible a lot more time in advance you need to plan it if you acquire some business property relief qualifying assets, such as AIM shares, more than 2 years before the anniversary, because if they're held at the 10-year charge date, then you have relief for that. So we now just move on to James, and he's going to talk about some more real-world examples and planning opportunities with trusts. Thank you.
Kat's explained the different types of trusts, how they're taxed, etc. So I'll look at how they can be used in tax planning. Firstly, with regards to will planning, so how they can be used on death, and then secondly, during lifetime. I'll deliberately try and give a brief overview. So I'd stress that there are other options almost always, and obviously bespoke advice should be required in each case. I'm also trying to stay away from the types of planning that David on the wealth management side might be advising clients. So, in terms of will planning, well, we will always advise clients, obviously, that they should have wills so that their estates do not pass under the intestacy rules. And the most basic planning for married couples or civil partners is usually to leave everything to each other on the first death, and then typically to their children on the second death. Now, this, of course, defers the inheritance tax charge to the second death because the spouse exemption will apply on the transfer to the surviving spouse on the first death. If clients want to make gifts on the first death, sometimes, they want to leave everything to their spouse, but, want to make, for example, cash legacies to family members and friends, etc., rather than including them in the will, it's usually beneficial, if possible, for the gifts to actually be made by the surviving spouse after their death, so that provided the survivor then lives 7 years, they're made free of inheritance tax. But that of course obviously relies upon spouses honouring each other's wishes in that regard. The final point here is, although clients will usually want the survivor to benefit on the first death, many will want to protect against care home fees, for example, or to ensure that their estate is ring-fenced from a second marriage of the surviving spouse, and that's where trusts can play a part, even in quite straightforward wills. So, what's the solution? Well, this can be done by leaving assets onto a life interest trust for the survivor on the first death. And in respect of the main home, that will mean ensuring the spouses sever any joint tenancy so that they hold their interest in the home as tenants in common. And that allows them to pass their interest in the home under the will rather than directly to the survivor by survivorship. Now, this type of life interest trust is an immediate post-death interest, which in which the surviving spouse is the life tenant and entitles them to enjoy the trust fund during their lifetime, and usually with the children being the remainder beneficiaries. Now, as Kat explained earlier, this is what we call a qualifying interest in possession for inheritance tax purposes. So that transfer onto this trust qualifies for the spouse exemption on the first death, and the trust fund is deemed to be within the estate of the survivor, or rather the life tenant, and therefore chargeable to inheritance tax on their death. So if we take a scenario here, quite a straightforward one, where we have married couple, all jointly owned assets, 350k property, 650k in cash and investments. There'd be no inheritance tax on the first death because everything passes by the spouse exemption. The estate of the survivor is valued at 1 million, and that would be entirely covered by 2 nil rate bands and 2 residence nil rate bands if assets pass to the children on the second death. Just one thing to watch out for, though, is this type of sort of flexible life interest trust that sometimes these are referred to in wills may name the children only as discretionary beneficiaries, which means that the assets actually pass on to a discretionary trust on the second death. So whilst this can usually be broken up easily if it's not required, it will mean that the residence nil rate band will not be available on the transfer of the half share of the property which is held on the life interest trust. Now, this is only relevant in some circumstances, so where the estates are small enough to benefit from the residence nil rate band. But if it is relevant, then planning in advance of the second death could be done to appoint the property or enough of the property out of the life interest trust to benefit from that residence nil rate band. A life interest trust can be used in more significant inheritance tax planning, and just briefly, for example, if there's a much larger estate, perhaps comprising assets pregnant with significant capital gains, and the first spouse to die wants to ensure they pass to their children, they could leave the assets onto a life interest trust for the surviving spouse, but on the basis that that life interest can be revoked in favour of the children as the remainder beneficiaries. Now, if that were to happen, there'd be no inheritance tax on the first death because everything would pass on to the life interest trust with the spouse exemption. And the subsequent termination of that life interest would be a potentially exempt transfer by the survivor. So no inheritance tax on that transfer either, provided they, of course, survive 7 years. Now, there should also be no CGT on that termination of the life interest and the transfer of the assets to, in my example, the children, because the assets would have benefited from the CGT-free uplift in base cost on the first death. So that's perhaps preferable if to a lifetime transfer by the first to die, because it would avoid the capital gains tax charge. Yet the trust and the ability to revoke it means that the first spouse to die can be sure that the assets will pass where he or she want them to. In terms of business property, clients should think carefully about how that is left in a will, because basic planning, as I've just explained, may not be appropriate. So, for example, what will happen to the family business if one spouse dies? Will the nature of the business necessarily change? Perhaps the trade will cease in favour of more investment activity. Will the business be sold because the spouse who's running the business is no longer around? If shares in a family company pass to the survivor, they'll do so without inheritance tax, of course. But if the business ceases to qualify for business property relief for inheritance tax, or if it is sold, that will then increase the inheritance tax exposure on the survivor's estate, because they would have turned an IHT efficient asset into cash or indeed other non-qualifying assets. Therefore, wills should often be structured to take full advantage of business property relief. Otherwise, clients are in danger, of course, of wasting the generosity of BPR if they leave on death business assets eligible for the relief to their spouse. So the problem is probably best illustrated with an example. So here I have Mr. and Mrs. A with the following principal assets. They've got their main residence, valued at £1 million, jointly owned, and shares in a family company, say, valued also at £1 million, but owned by Mr. A. Okay, if Mr. A dies first, leaving everything to Mrs. A, there's no inheritance tax on his death, as everything passes with the spouse exemption. But if Mrs. A sells the business for £1 million, on her death, the estate of £2 million is liable to inheritance tax without the benefit of business property relief. Essentially, what that means, even with the 2 nil rate bands and 2 residence nil rate bands potentially, we have a taxable estate of £1 million, which gives rise to an inheritance tax liability of £400,000. If instead Mr. A had left the shares of the family company onto a discretionary trust and all other assets to Mrs. A, the inheritance tax position would be as follows. Okay, there'd be no inheritance tax on Mr. A's death. The shares would pass on to the trust with business property relief, and the other assets would pass with the benefit of the spouse exemption. If the shares are then sold by the trust and the proceeds remain outside of Mrs. A's estate, they obviously will not come into charge on Mrs. A's death. Okay, so the proceeds would remain within the trust, subject to the relevant property regime for inheritance tax, but that's perhaps a small price to pay for avoiding inheritance tax on that £1 million. And therefore, in that simple scenario, a quite simple solution, potentially it saves inheritance tax of up to £400,000. There's also an opportunity to claim business property relief twice on the same assets if business assets are likely to be retained, and this is done by what is known as a double dipping will, so a double dip of business property relief. Okay, this works on the basis that on the first death, everything is left upon a trust, which will subsequently have 2 funds, a business property fund and a residuary fund. Okay, now as illustrated in the simple diagram here, the business assets will pass on to the business property fund, which is a discretionary trust, and the rest of the estate passes on to the residuary fund, which is a life interest trust for the surviving spouse. Now, this incurs no inheritance tax on the first death because business property relief will apply to the transfer onto the business property fund, and the spouse exemption will apply on the transfer into the residuary fund of all the other assets, the other chargeable assets. Then, usually after at least 3 months has passed, the trustees will sell the business property relief assets, so the business assets, from the business property fund to the residuary fund, and values may be such that assets can simply be swapped. Okay, and then as illustrated on the screen here, the residuary fund will hold the business assets. So that means that business property relief will be available again on the death of Mrs. A as the life tenant, provided she has held the interest for 2 years before her death. And the chargeable assets will be in the discretionary fund and outside of her estate. So again, the discretionary trust is liable to relevant property charges at up to 6% every 10 years, but that's perhaps preferable to the 40% charge that would apply on death. And of course, assets can be appointed out of the discretionary fund in favour of other family beneficiaries if they're not required by, in this example, Mrs. A. Okay. So for the final couple of minutes before I hand over to David, I'll look at a couple of ways that trusts can be useful during lifetime as a tax planning tool. So in the first example, clients have an investment property which they want to give away for inheritance tax purposes, but they don't want to incur a capital gains tax liability in doing so. As you'll know, the transfer of chargeable assets for capital gains tax purposes, even by way of a gift, will give rise to a capital gains tax liability. Now, in my example here, the value of the property is within the nil rate bands. So Mr. and Mrs. A have an investment property worth £600,000. They both have an available nil rate band of up to 325,000. Okay, they could settle, therefore, that property onto a discretionary trust with no inheritance tax liability. But because they're transferring it onto a trust, subject to inheritance tax, albeit at 0%, they can claim holdover relief for capital gains tax under Section 260 of the Chargeable Gains Act. Okay, following this, there should be no inheritance tax exit charge if capital is subsequently appointed in the first 10 years. So it might be that the trust would be, might have a life of less than 10 years because ahead of the first 10-year anniversary, the trustees might decide to appoint the property out to beneficiaries, for example. Now, this trust would be effective for inheritance tax for Mr. and Mrs. A, provided they are excluded from benefiting. And the only other point that I'd make here is that for property disposals made after December 2003, it's not possible to claim holdover relief under Section 260 and then subsequently claim private residence relief on a later disposal. So, we have got to take care in deciding whether this is appropriate if, as in my example here, the investment property might actually be used as a residence for one or more of the beneficiaries. And my final example here is how trusts can be used by business owners, not for inheritance tax planning, but to undertake some income tax planning. Okay, so in this example, or in this scenario, again, Mr. and Mrs. A own 100% of the share capital of ABC Limited, which I said is a profitable family company which they founded. Okay, they are the only directors of the company, so they own the entire share capital and they are in control of the company from a director viewpoint as well. They wish to draw further profits from the company to pay private school fees of their grandchildren. Now, their personal incomes already exceed 125,000, so they're additional rate taxpayers, which means that any further dividends they draw from the company will be liable to income tax at 39.35%. What they could do to improve the income tax position on further dividends, or dividends specifically for the benefit of the grandchildren, would be to redesignate and settle some of the shares of ABC Limited onto a discretionary trust. And I'm suggesting here perhaps 5% of the share capital. Okay, they would ensure before doing this that the shares qualify for business property relief, or the value of the transfer is less than the available nil rate bands they have available to them. Okay, now the transfer of the shares onto the family trust would qualify for holdover relief for capital gains tax under the same provision as I mentioned a moment ago. So at this point in time, the trustees own 5% of the share capital of a different class to Mr. and Mrs. A. So potentially dividends can be paid to the trust to the exclusion of Mr. and Mrs. A, and vice versa. Okay, but it's a discretionary trust. So if the discretionary trust received dividend income, it would pay tax at 39.35%, and then income distributions would have to be made to the beneficiaries, in this example, the grandchildren, franked with a 45% tax credit, and there'd be the administrative burden of the grandchildren having to recover that. To make things more straightforward, the trustees may appoint a life interest in favour of the grandchildren, usually on a revocable basis. Okay, so it can be taken away or changed in the future. And they would perhaps mandate the dividend income directly to them. So the children would have a present right to enjoy the dividend income on the ordinary A shares in my example, and those dividends would be mandated directly to them. Okay, and that means that the grandchildren would receive directly dividend income and be taxable on that accordingly. Okay, so if they've got their personal allowances, dividend allowances, basic rate tax band, etc., available to them, you can see that scope exists for quite significant dividends to be paid out at much lower income tax liabilities than would be the case if Mr. and Mrs. A received the dividends themselves to then use the funds to benefit the grandchildren. Okay. Now, in this scenario, the settlements legislation won't apply, but great care has to be taken to ensure that is the case. It works very, very well for, in this example, where we have grandparents with their own company who are clearly in control, both at shareholder and director level. There can be scenarios where this is not appropriate, and particularly where parents of minor children are involved in some capacity, for example. And on that note, I think I hand over to David to present the last third of the webinar.
So thank you, first of all, for inviting me along today. My name's David Hume. I'm an independent financial advisor working from the MHA London Wall Place office. So I work very closely with James and our tax and audit teams to offer integrated wealth, tax and financial planning service to our private and corporate clients. So I'm sure that I don't need to advise or talk to any of the attendees today that clients like the idea of saving tax. So there's been lots of rumours on potential changes to IHT and inheritance tax in recent months. And really, depending on the party that you feel may get in power through the next general election, these rumours vary from Labour apparently wanting to scrap or reform a number of the IHT tax reliefs, including agricultural business relief. Or apparently, if you believe what you read, the Conservatives are also considering abolishing IHT altogether. So first of all, I'll say these are just rumours, and you may or may not have your own view on the likelihood of who's going to win, whether the parties will actually do anything behind closed doors, and really if they really want to look to implement these changes, given the impact it's likely to have to business. So really what I want to do today was say that when we're meeting clients, we make them aware of the rumours when consider IHT planning, but we also need to ensure they're not missing out on any opportunities that are currently available. So that's where I work really closely with James and his team. So when we're considering transfer of wealth, then quite often we start talking about pensions, but you'll be pleased to know that I'm not going to talk about pensions anymore in today's presentation, but I'm going to talk about opportunities where we may use trusts. So the two main occasions being when we consider using investment bonds and also using life assurance policies. So as a financial advisor, it's very common for me to consider using either an onshore or offshore investment bond as part of an investment solution due to their beneficial tax position and how that might meet a client's needs. But it's often important to clients that if they are looking to give money, they don't want to lose control of their assets whilst looking to pass on their wealth to their family. So that's where investment bonds can work very well. So what I'll be going on is just talking about some of those ways that we may use trusts. So generally, when we're looking at the different types of trusts, I know that Kat and James have gone through those. I'm not going to spend much time talking about the different types of trusts today, but I will cover probably the two most popular types of trusts that I would use with investment bonds, being the discounted gift trust, also known as DGT, and or a gift and loan trust. So the discounted gift trust is popular for many reasons, but as you saw on the last screen there, as I say, has some of the greatest IHT benefits. So I've normally considered really a great option for clients who's looking to move a sum outside their estate for IHT, but at the same time enjoy and maintain an attractive regular payment for the rest of the lifetime or until the fund is exhausted. So an investment bond is used to enable a settler to access the allowable 5% deferred tax capital withdrawal, which is allowable through an offshore-onshore bond. The settler, however, will not be able to access the gifted residual fund, nor access any future growth on the investment trust. So investment bond, because they're owned by the trust. So these are trusts often considered, due to those constraints, for more elderly clients who are willing to not have access to that capital in the future. However, the younger the settler is, then in fact it may be greater the discount. So importantly, a DGT is underwritten and therefore it can provide that HMRC approval. The provider will consider issues such as the settler's health, their age, life expectancy, their lifestyle, maybe interest rates, and it may in fact require medical underwriting such as questionnaires and GP reports. But that will then enable one of the main attractions being the immediate discount. So what do I mean by that? The settlers will have retained benefits due to how long they're expected to live. So that fund is actually set aside for the level of capital withdrawals you can reasonably expect them to receive during their lifetime. And I say importantly, that's then discounted immediately for the in respect to IHT. So how does that work? It's fine me just talking about. Let's try and just show you a graphical example. So in this case, it's very common that clients want to keep the trust to the nil rate band, being 325,000. That way, there's no chargeable lifetime transfer to pay. So in this example, due to the discount that they would benefit from of 55%, they can in fact put into the trust arrangement £722,222 it's calculated at. So that's a discount of 397,000. So that amount would be classed as being straight outside their estate for inheritance tax once it's been put in place. The remaining, the residual fund, gifted residual funds, they won't be able to access. And I say in respect to that, that's then considered to be outside the estate after a 7-year window, the normal 7 years before that would be classed as being outside the estate. It then would depend if it's discretionary or bare, how that would be treated. But importantly, they're doing some good planning. They're moving a larger amount technically than just the nil rate band outside their estate, and they are maintaining the ability of that fixed level of capital return or payment. Next screen, if you could, James. So I've now got 2 more slides, and again, time constraints with time moving on. These are just really showing some of the main advantages, and also next screen, James, the main disadvantages of DGT. And as I say, they're not right for everyone, but especially elderly clients. As I say, they can be a very useful investment trust structure, to consider. We may in fact use a combination of trusts. Next screen, that you're on there, sorry, James. The gift and loan trust. So this is the next type of trust I want to explain. I consider it in a way, a bit of a halfway house, really. So with the gift and loan trust, what they're looking to do is maintain ability to access either lump sums on an ad hoc basis, regular payments or occasional payments, or most commonly, regular payments of 5% of the original capital back. So this type of arrangement, this type of trust, enables them to access back the capital at any time. Where therefore you may question, are the IHT benefits? Well, the IHT benefits in the planning is through any future investment growth that trust may make, and that's owned by the beneficiaries, the trustees, rather than you being able to access that money at any time. So again, just bringing that to life, this is just showing you roughly how that might work. If a client is looking to take 5% withdrawals through the 5% deferred, tax deferred withdrawals of an investment bond, then they're taking that for the 20 years. It shows if you're getting a potential growth of around 6%, over time, over the 20 years, there's going to end up a good level of capital outside the estate. But in the meantime, they've been enjoying the return of capital to ensure that the capital is outside and spent during that 20-year period. The downside, or one of the downsides of a gift and loan trust, is sometimes clients set them up but don't access the capital, because if you're doing that, it's just going to fall back into the estate. Again, I'm not going to go through these due to time, but we have the advantages and also next screen, the disadvantages of using a gift and loan trust. So they're there for your future reference. So using life assurance is really the next thing I want to talk about. So life assurance is being used more and more for things such as inheritance tax planning, and therefore trusts associated to those. So the four main things that or benefits of using the life policy is the proceeds can be paid directly to the trustees without the delay of probate. You can nominate who you wish. The proceeds can be held outside the estate for IHT, and next screen, and it really provides greater convenience. So should you fall ill, if you have critical illness written into the policy, then the trustees can act on your behalf and deal with the claim on your behalf. So as independent financial advisors, we look at the whole of market to really find out the most cost-effective and suitable policy for each individual's needs. They will vary. We're also going to offer the ability and the advice by us rebating any commissions back into the policy and actually charging a fee. That's going to save the client money during the term of their policy. There are quite a few types of policy we use. I've named a few of them on the screen, so I won't go through those, but probably the most common reason we would use a trust with a life policy is in relation to IHT and meeting that liability. That might be a term policy, it might be convertible term, it may be gift in a vivos, or most commonly it'll be a whole of life policy on a second death basis. So again, just to bring that to life a bit, if you're using a life policy, it's going to enable money to be paid very quickly on death to the trustees, beneficiaries, to ensure that money's there available to pay the IHT bill, so that money can go to the right people at the right time. So just to bring that bit to life for you, we have a case study. We have Bob and Maureen. They've got IHT liability of 500,000, age 62 and 60, and non-smokers. So what would a policy cost for them? Again, we've obviously had to look at an example of some premiums here. So these are ones which were provided by Royal London. Again, different companies will have different prices and different types of policies and benefits provided. But for guaranteed policy, so guaranteed policy is generally the preferred option, because that gives you a guarantee of the sum assured, and also secondly, a guarantee of the premium remaining level throughout the term of your lifetime. The policies, however, can be varied. You can, should you need increase the policy should your liability change during the time, also decrease it should you gift during the actual period. Also, you might actually be able to save some of the costs by paying the premium paying the premium annually, which might work out about 5% cheaper. So do you consider that expensive? Well, let's try and put that into perspective for you. So £640.20 per month. As I say, if we look at the expected lifetime, I feel that offers good value. It is meeting their objective of ensuring they're covered for that level, and there's no investment risk attached to that. Sorry, just go on to the next screen if you could. That excellent, thank you. So this really just helps put that into perspective. So the 640.20 per month. If you looked at the life expectancy in the top there of 32 years, and you looked at investment return or deposit return compounding of 3.25 net, then it's actually going to take them 35 years of paying that amount into a savings account to try and achieve the same outcome. So in my view, that's offering good value. There is another option when we look at whole of life, there's reviewable policies. So what's the difference? Well, it's going to be cheaper. So the policy will be reviewed first after 10 years and then every 5 years going on. So it is giving the option for somebody who wants to put some cover in place at a lot lower premium. So as you can see, they're £67.22 to begin with. That, however, will increase significantly during the lifetime. If they live to their normal life expectancy, that this type of policy would work out more expensive than the guaranteed. It may be, if we look at the next screen, that we would actually use a combination though. So somebody has or is expecting to gift money, then you may use the reviewable for say 250,000, and then the guaranteed policy for the other 250, and then you can stop the reviewable policy once the gifts have been made and they're outside the estate, and you're actually covering yourself for a lot less cost. So I'll try and cover these very quickly. I will leave, as I say, they're quite wordy. So there's quite a bit of info on here in relation to using business relief investments. So there are various different types of business relief. The importance of using business relief is that assets can be moved out the estate quite quickly. So holding those investments, maintaining them for 2 years onwards will ensure that those assets are currently considered outside the estate. Two main types are unquoted or trading companies who often use, say, wind farm, alternative energy, fibre, warehouses, and so on as the underlying assets. There's also AIM listed, so may be more commonly known by individuals, where you're looking to invest in the alternative investment market and get returns depending on how those shares and portfolios perform. Quite importantly, not many people necessarily know that you can move ISA monies into AIM share portfolios and actually have those assets moved outside your estate. So not only would those ISA funds end up being CGT and ISA and income tax free, but also free of inheritance tax. So there's a couple of case studies, which again, I'm going to fly through these very quickly. So what we have here is how inheritance tax planning for clients settling assets into a discretionary trust. So what you may have is, next screen please, is that they've got an existing portfolio. As I say, they already made gifts. As I say, there's an investment for 500,000, and I say because of the level of their estate, as I say, they're looking to potentially settle the cash into a discretionary trust. The issue being there'll be a chargeable lifetime transfer. So what we're actually looking to recommend instead is moving 500,000 of the portfolio into qualified business relief investments. So in respect to that, as I say, the benefit of it is that by putting the money into the business relief, it will be outside the estate after 2 years. So there'll be no chargeable lifetime charge actually made. And then they can actually move that asset into a discretionary trust after that 2-year holding period. If we go to the next slide very quickly, James. So this sort of just shows the difference of how that would work, of either putting it into the business relief investments, and it shows the saving of the 20% charge for lifetime transfer of 100,000 by taking this approach. And again, another case study just very quickly on using an existing business relief investment. If we go through the slides, if in this case, the individual had lost their their residence nil rate band in relation to IHT due to the overvalue over total value of their estate. However, she did have, if we go on the next slide, an investment which was already in a business relief investment of 350,000. If once she had that already for 3 years, if she moved that into a discretionary trust, on the next couple of slides, please, James, you'll see the benefit of that because it was already outside the estate as it was over the 2-year term. By moving it into the discretionary trust, it's then giving her back the residence nil rate band, which the next picture will show would have the saving of the 70,000 for her. So those are some good case studies. As I say, just give you an overview of some of the ways that we can use trust, and I hope that's been helpful.
Thank you, David, and thank you to all our speakers. Super material, such a complex matrix, isn't it, that we're dealing with here. So before I just start getting some of the Q&A, just to remind you that you are able to pick up with our speakers after today's close, which will be in about 15 minutes. But to do that, just need to attend to the opt-in poll. So after doing that, I'm going to start looking at some of the questions here. I think I've picked out a few. Some of them are more specific and particular, some are more general. So one I was going to ask with I think probably Kat is, given that most pensions are in trust, do these have to be put on the register as well?
UK registered pension schemes are one of the excluded trusts, so they're not registerable because they're already registered as pension schemes, so they're generally excluded. Right,
thank you. That's what I thought, but thanks for that confirmation. Perhaps one more for you. Do HMRC send a form to be completed for the 10-year charge, or do trustees have to initiate that process?
Generally, it's the trustees. It's a self-assessment process, so the trustees have to do it, but they have actually started a pilot from the beginning of this month to send out notices based on the data on the trust registration service. So I think it's sort of the first time they've ever really had the information available to know when a trust would have a 10-year charge to be able to do it. But historically, and still in the main, you are responsible for making the self-assessment of your liability to the 10-year charge.
Okay, thank you. I've got a question here that I'm going to pose. I'm not quite sure who to pose it to, but it's quite an interesting one, so I'll just present it. Is a local authority an asset impairment, excuse me, on care homes? Any thoughts and comments on what might need to be disclosed that could result in an impairment for care home fees being met? Quite an interesting question. I haven't really got an answer to that one in my head, but I'm sure with a bit of thought you might be able to generate some thoughts on that.
Yeah, I'll start off, although basically just to say it's a difficult one for us as tax advisors to answer. I don't know if Kat or David have any views, but we are aware that where I understand clients or people, or rather where there is a kind of deliberate deprivation of capital. So if something is done in contemplation of possible future or near future means tested fees, etc., then the local authority can look through those arrangements. But I have to say I'm not any more aware than that. I don't know about Kat or David.
I can see the question. It's specifically asking about IPDs, and I think in those cases you wouldn't have a deprivation of assets because the person who's died and left the assets onto trust has no obligation to leave it to the spouse. So they couldn't say that the spouse has deprived their assets because the person who died put it into trust in those specific circumstances. But you do have to be wary if this person who's still alive has put assets into trust.
Thanks, Kat. So in other words, just some in the generality that there are planning opportunities around in there, I think, isn't there? Probably the general answer to that one. Maybe one for James here. Would IHT not be due in the example read a discretionary trust being set up with shares in the trading company if the shares are sold within 10 years and then other assets are distributed? Or can you distribute the cash from the sale tax free?
No, I think I did caveat what I said and said, look, by leaving business relief qualifying assets, so in my example, shares of a trading company onto a discretionary trust, then you get the business property relief on the settlement. But if they are sold in that first 10-year period, the advantage that I explained was that those sale proceeds arise to the trust rather than the estate of the survivor. So we don't have a potential 40% charge on the death of the survivor, but those proceeds are within the relevant property regime and will be liable to inheritance tax or an inheritance tax exit charge if they are appointed, albeit ahead of a disposal of those shares. There may well be a conversation between the trustees and indeed the beneficiary, and the principal beneficiary would usually be the surviving spouse, as to whether those shares should be appointed out of the trust. It might be appropriate, for example, if the surviving spouse doesn't need access to the capital or some of the capital to be derived from the sale of the business in my example, then those shares might be appointed out of the trust to the next generation. And of course, they could be appointed out whilst they still qualify for business property relief, and therefore an exit charge wouldn't be levied.
Thank you, James. Thanks for clarifying that so nicely. Excuse me. One for David now. I think there's quite a lot of interest being attracted around DGT planning trusts, which maybe in some respects sound too good to be true. You can kind of have your cake and eat it almost. So one question that came up from that was DGT and gift with reservation of benefit issues still benefiting from income ? So maybe just a little bit of clarification around that.
I'm trying to see that particular question. So I did see there was a few on here. What I'll do, I'll just quickly run through the ones I see on the SIFT and the SIFT.
That's fine.
I mean, I can jump in, David, if you want, from a tax perspective, particularly in that the income, in inverted commas, in other words, the payments made to the settlor during their lifetime aren't actually income; they're just a return of capital. The growth, if you like, the income gains of the investment over the period are rolling up within the bond and will eventually become chargeable, albeit on a deferred basis when the investment bond itself is cashed in the years to come. Would that be a reasonable answer, David?
Yes, yeah. I mean, as you say, the important thing is it's not income; it's return of capital. I see another question here in relation to somebody has asked about the wealth preservation trust. That's actually my understanding. That's one of the options of trust available through one of the providers, being Canada Life International. So it's probably a better question to direct to them. But where the settler got the 5%, they said they were entitled to another 5%. That's not correct. As I say, it's potentially tax deferred, and it's only it's definitely not tax free. And it would depend on, importantly, that the 5% does also need to include fees, maybe which have been charged advisor fees. So anything over and above that 5% can trigger, a tax liability. Yeah, I think the terminology is just been a bit incorrectly used, maybe by Candlelight there.
Yeah, thanks for that to both of you. One for Kat, which I suspect the answer's the same to pensions, but I'm not sure, is trusts, but life insurance trusts, do they have to be registered?
That's more of a difficult one. So some that are just life assurance policies can, but I believe if they're ones that you can cash in during the lifetime, they are registrable. There's very specific conditions, and I would generally pass it back to the life insurance company or the financial advisor to ask if they believed it fit in with the specific definitions of an excluded life policy trust.
Yeah, many of them would be excluded, as you say, Kat, but it's always best to double check on depending on the policy.
Yeah.
Thank you. One question that's quite an interesting one that you might, between you, like just consider is, you didn't cover agricultural property relief, woodland or farms. Are there some opportunities in that, or perhaps not so much as people may like to think? That's one for James to begin with.
Cool, yeah. I mean, it's deliberate we didn't cover all the reliefs because we could talk all afternoon. I mean, in many ways, we could use agricultural property and interchangeably with business property in our examples, other than to say that, where you've got agricultural property that perhaps doesn't qualify for business property relief, you just need to be very careful, because agricultural property relief only applies on the agricultural value. So we often have issues where perhaps there is land that qualifies for agricultural relief where there might be some development value. Yeah, not sure. What were the other examples? Woodland relief and such like.
Yeah, woodland, farmland. Yeah. Used to be very popular, I think, in the 70s, didn't they?
Yeah, I mean, I probably couldn't say any more about woodland relief. Something we come across pretty rarely, to be honest. So I wouldn't want to say anything different. I don't think, to what I've just said.
That's fine. Yep, thank you. More specific one. Would it be possible to use bear trusts to transfer an investment property's beneficial ownership in respect to both income and capital gains to a lower rate paying spouse, thereby saving tax on rental income?
Yes. I mean, a bear trust, as Kat explained, is an absolute gift. So the bear trustee would just be holding the property on trust for the, in this example, the other spouse. Absolutely. And so that's just a transfer between spouses, no gain, no loss for capital gains tax. The income will then arise to the beneficiary spouse and can therefore potentially benefit from a lower rate of income tax. Care just needs to be taken here if the transfer is such that it results in joint ownership. So we might have a situation where, in this example, the transferor declares that he or she is holding the property on trust for themselves and their spouse in whatever proportions, but crucially they own it jointly. Now, in that situation, as spouses, from a tax perspective, income is automatically shared equally, irrespective of the underlying beneficial ownership. And if spouses wanted to have the income taxed in accordance with the underlying ownership, perhaps the underlying ownership was 90%, 10%, then they'd have to make a Form 17 election to have the income taxed in those proportions.
Okay, thank you. And maybe I'm going to make this the last question, so that we can have a bit of a round robin thoughts from all of you on this. Is the question actually is are trusts in the current tax regime really there for protecting assets or tax planning opportunities? I think perhaps the answer is both.
Blimey. Well, I think in our I mean, my comment would be in our examples, they provide access to both, or they facilitate both, certainly. And sometimes actually, we have to emphasize the non-tax benefits of trusts to clients, because they may well be perceived by some to be used for tax purposes, but of course there's much more to trusts than that. I don't know what the others might say in response, if anything.
I think if you've got a discretionary trust, they've got the high rate applicable to trust to pay on the income, but we've got the option that you mentioned about defeasible life interest from discretionary trusts, which bring in the basic rates of tax and help with that cash flow. So there is still tax savings for income tax as well as inheritance tax and protecting the assets. So obviously 6% in a trust is less than 40% in an estate. So
yeah, they also offer a lot of flexibility, don't they, as well? I mean, ignoring the tax benefits here, if someone is looking to provide for, a class of beneficiaries, for example, so you might want to leave something in your will to your grandchildren, but there may well be other future grandchildren that they're not aware about at the time of drafting that will, then something like a discretionary trust can be very useful. Yeah, I think that's probably as far as I would go.
I mean, that all seems totally appropriate, and it's such a complex matrix of things that are going on here, isn't it? In terms of what you want to achieve and how you can achieve it and what the priorities are. So my kind of concluding message, I think, is that when things are complex, you need to have a very clear prism on identifying your priorities and what you're actually trying to achieve. Your real goals and objectives is where you kind of need to start. And then you need to have a trusted team of people around you that are able to put forward the most effective and efficient ways of meeting those objectives. But prioritization, as with all things, is kind of what you need to establish before you can start to put the tools in place. And clearly, from listening to our three excellent speakers, there are many, many ways that this can be addressed, both from a protective position, which could be protection against divorce, for example, for children subsequently, and from a tax efficiency perspective. Trusts are an immensely useful tool to have in that proverbial tool bag. But I think it is all about integration, clarity, and having a trusted team together, which is, I think we've done, our speakers have done wonderfully well today to cover such a lot of complexity, but you have got the possibility of picking up afterwards. So I hope you enjoyed our webinar. I certainly did. And if you're not a member of the personal financial planning community, do please join, because it's an excellent portal for picking up not just information that's previously been delivered, but also subsequently to be able to be aware of what things are going to be going on for the rest of the year and next year. So I look forward to meeting you all again. Thank you for joining us, and thank you to our speakers. Thank you.